You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Barratt Redrow, Coca-Cola HBC, British American Tobacco, Magnum, Unilever, and our US company of the week is Shopify. So, shall we start with Barratt Redrow?
Yes, how are they doing?
So they're doing all right. They had their half-year results out last week, with first half revenue rising by 11% to £2.6 billion. Growth was largely driven by a 5% rise in total completions to 7,444 new homes and a rise of 4% in selling prices to £365,000. Underlying pre-tax profits fell by 14% to £200 million against a consensus of £205 million, as higher use of buyer incentives weighed in on margins. Free cash flow fell by around 100 million to 300 million, and net cash fell by around 300 million to 200 million, largely due to an increase in inventories, but is expected to recover to around 400 to 500 million by the year end. Full year guidance has been reiterated, with the group expecting to complete between 17,200 and 17,800 new homes this year. Full year underlying pre-tax profits are expected to rise around 21% to £590 million against a consensus of £597 million. An interim dividend of 5 pence a share was announced, which is down from 5.5 pence, and shares fell 5% in early trading. In terms of valuation, Barratt Redrow has a market cap of 5.35 billion and trades at 0.68 times forward price to book, compared with the 10-year average of 1, and it has a prospective dividend yield of 4.4% compared with the 10-year average of 6.1%. I thought these results were fair. However, profits slightly lower than expected with the increase of incentives to stimulate the demand. I think to some degree you can attribute that to the uncertainty around the budget and the impact of that timing there on these results, because there genuinely was a lot of uncertainty. But more sort of key to these results was the soft demand around London and some of the affordability issues. It's also, you don't like to see a dividend cut. I think it probably should be, but that was, again, I think, impacted on the share's reaction with it. I think these concerns are all reflected in the very low valuation, and it's been around this sort of valuation for some time now. And you do feel, and I know I've been saying this for a long time, but at whatever point there is planning reform, reformed stamp duty, and possibly even the lifetime ISA, which sort of caps the maximum house price to 450,000 that you can use it towards, particularly with where Barratt Redrow are operating and with the Redrow acquisition, which is more expensive houses, that actually with some of those changes, potentially they could be tailwinds for the business if you had those reforms. But as I say, I've been saying that for a long time. I do continue to hold the stock, and I don't think anything has fundamentally changed here. I do remain optimistic for the long term, but we would really have to see, I think, those changes before it does unlock the value here. And I think comparing it, because we did have Taylor Wimpey not so long ago, and when you do compare it with Barratt Redrow, one of the things that you notice more, particularly even if you compare it with Persimmon, where there's more, a northern bias to the house sales, they are at the lower end of the market and in an area where these things, the valuation perhaps isn't as, impactful in the sense that lifetime ISAs, for example, can be used to purchase those properties. And I think Barratt Redrow is kind of sitting at the other end of that spectrum. So probably a deeper value play in that sense. But yeah, it has, I think, disappointed for some time now. Sam, what are your thoughts?
Pretty similar. I think when you actually compare it to Taylor Wimpey and Persimmon in terms of the latest results, they're all pretty similar. They're all getting squeezed a bit on the margins. The order books are okay. I think Taylor Wimpey had the worst order book. I think they're all suffering from similar problems, although they are in slightly different ends of the market. I don't think the results are terrible. I don't think the dividend cut is that much of a concern. It is a cyclical business, so I wouldn't be too concerned about that. And I do agree in terms of the valuation. I think it's kind of the most attractive it's probably been for a long time. I know the share price hasn't actually moved that much in the last year, but I just still think it's quite a good business if you look at it at that price to book. I think it's attractive. I think you could say that about any of the three. I think you could say the same about taking a basket approach. I don't know what it would take to kind of unlock some of that value in the house builders. Because I think the issue they've got is it's becoming harder and harder to raise prices. So they are just getting squeezed on the margins. Previously, the approach to that, if you go back kind of 5 or 10 years ago, it was sort of try and find cheaper materials and stuff, but then that led to build quality issues. So now they are just getting squeezed and there's little they can do. I think with Barratt Redrow, I think they probably benefit the most from the reform of the lifetime ISA, because they probably have more properties that are being affected by that 450k cap. So I guess maybe that's an argument, maybe slightly more in favour of Barratt Redrow over some of the others, but I think they're all pretty similar.
Do you think if interest rates continue to come down over the next year, that will have any meaningful impact on the house builders?
Probably, but if it just leads to a corresponding increase in prices, you win on one side and lose on the other. But I don't know. I struggle to see it. I just think, because at the minute I think we're about 4%. Compared to historical norms, that's pretty reasonable. And then you've just got this anomalous period where rates were 1 or 2%.
Yeah.
I don't think we'll go back to that. That's my view.
Yeah. No. Fair enough. I would largely agree, I think. But anyway, shall we move on to a more growthy company?
Absolutely. So it's Coca-Cola Hellenic Bottling Company. It is probably one of the favourites of the show. It's a company that's now in our fantasy portfolio. They now operate in, I think it's 29 countries now. So at the minute they're operating in, they've got 3 markets. They're split into established, developing and emerging. So the established market, and what they do is they do the bottling for Coca-Cola and the distribution in those countries. It works in the same way as Domino's UK does with Domino's US. So established markets, that's Austria, Cyprus, Greece, Italy, Northern Ireland, Republic of Ireland and Switzerland. Developing markets, that's Croatia, Czech Republic, Estonia, Hungary, Latvia, Lithuania, Poland, Slovakia and Slovenia. And emerging markets is Armenia, Belarus, Bosnia and Herzegovina, Bulgaria, Egypt, Moldova, Montenegro, Nigeria, North Macedonia, Romania, Russian Federation, although that market, as you can imagine, is non-existent now, Serbia and Ukraine. It's worth mentioning that as well as that, and we did cover it sort of back in, I think it was October, they have announced a deal to basically buy their African counterpart. So they are going to be getting a load more countries. Like Coca-Cola, they basically bought the African version of themselves. So that gives them a further 14 countries, all of them in Africa. That nicely complements, firstly, the markets they're in, but they already had Egypt and Nigeria as markets anyway. So they have come out with full year results. And worth noting, because the Africa deal, it was only announced in October, they're not included in these results. I don't know if the deal's gone through yet anyway. I don't know if it's just been announced, but they're still actually dealing with it. But in any case, these results are just the traditional markets, not the new African ones, which will come in next year. So full year results for Coca-Cola Hellenic Bottling Company, and volume was up 2.8%. Net sales revenue was up 7.9% to 11.6 billion euros, and all these figures will be in euros. It was actually up 8.1% on an organic basis. The net sales revenue per unit case was up 4.9%. Operating profit was up 10.1%, and comparable operating profit was up 13.8%. The EBIT margin was up 20 basis points to 11.3%, and the comparable EBIT margin was up 60 basis points to 11.7%. Net profit was up 14.6% to 940 million, and comparable net profit was up 19.4% to 989 million. Basic earnings per share was up 14.9%, and free cash flow was down 2.3%. If we split by segment, for the established market, organic revenue was up 2.3%. That was mainly driven by revenue per case expansion, with volumes flat year on year. And the EBIT declined 2.8%, driven by a step up in investment. For developing, organic revenue grew 6.1% with good revenue per case expansion and volume growth, and the organic EBIT grew 5.6%. And in emerging, organic revenue increased 13.2% with strong volume growth led by Africa. Organic EBIT grew 23.2%. I'll just check what Africa includes there. Yeah, the acquisition's not completed for Coca-Cola Beverages Africa. So when they say that Africa's doing really well, they're just referring to Egypt and Nigeria. But that hopefully bodes well for the 14 other African countries that are going to be coming in. So organic volume overall grew 2.8%, as we said, and that was predominantly driven by sparkling up 2.5% and energy up 28.3%. They had value share growth of 80 basis points in non-alcoholic ready-to-drink, resulting in the sixth consecutive year of share gains. The operating expenses as a percentage of revenue increased 10 basis points, reflecting higher marketing investment to leverage growth opportunities, and the return on invested capital was up 100 basis points to 19.4%, driven by higher profit. Net debt to comparable adjusted EBITDA at 0.7x, so that seems fine. And the ordinary dividend has been increased by 17%, and that represents a 44% payout ratio, so that's pretty well covered. As mentioned, they agreed the acquisition of Coca-Cola Beverages Africa on 21 October 2025. They've highlighted ongoing standout performance of energy with the 10th consecutive year of strong double-digit growth, supported by innovations of Monster and Predator and Fury in Africa. Strong growth in coffee in the out-of-home channel, driven by both Costa Coffee and Cafe Virginano, as we executed our strategic decisions focused on this channel. So if we go a bit further into two of the more interesting markets, coffee, because Costa themselves have been struggling and Coca-Cola has been looking, or Daddy Coke has been looking to get rid of it. They said coffee volumes grew by 26.5% in the out-of-home channel, driven by both Costa Coffee and Cafe Virginano. As we grew in existing outlets and recruited 2,100 new outlets, we saw a decline of 19.8% in total coffee volumes, in line with our expectations as we executed on our joint strategic decision from the start of 2025 with Costa Coffee to focus primarily on the out-of-home channel, where we see greater long-term potential. And in premium spirits, they said volumes grew by 12.2%, with double-digit growth across all segments. A key driver was our own brand, Finlandia Vodka, for which we launched a new global campaign in April, contributing to increased brand awareness and market share gains in key markets. Distribution partnerships with Brown-Forman, Bacardi and Edrington also continued to deliver growth, and we executed a successful launch of Bacardi and Coca-Cola. In terms of the valuation, the business trades at a PE of 21 and has a dividend yield of 1.85%. And in terms of the share price, it is basically at an all-time high at the minute, £47.82. It's up 21.79% in the last month, 33% in the last 3 months, and 45% in the last year. So, yeah, I mean, it's a really good set of results. Doesn't even include the African acquisition yet, which I think, based on what we've seen from Egypt and Nigeria in those results, is going to be pretty high growth. Really exciting business. Really like it. I think the valuation, I think you can still make an argument for it at 21. It's not cheap, but it's a really, really high quality business. And, you know, we can sit and complain about the price, but if we want it's cheap, we have had opportunities to do so and haven't. The only thing that softens the blow is, at least at the start of the year, it went into the fantasy portfolio. But unfortunately, that's not real money. But at least it's gone in there. So yeah, great company. I'd love to own it, but I just don't know if I want to pay 21 times earnings for it. What about you, John?
Yeah, I think I'm used to it being 15 times earnings and about £15 a share, although it hasn't been that. I think first time we covered it, it was maybe about £15 a share. And it's one of those businesses that we've followed now, and then you've gradually appreciated the quality of it and how good management have been, and yeah, the astute decisions that they've made. I think this new acquisition is really smart, and it looks like it's going from strength to strength. However, could I pay 21 times earnings? That's more the difficulty. But yeah, and there's regret, there's anchoring, there's all of that. So there's a lot of psychological baggage that comes with it. But it looks great, and it is good to see it doing.
But if you already held it today,
yeah, I know what you're going to say.
Continue to hold it.
Well, the answer is probably yes, and I appreciate that it's not logical, and you know there are lots of psychological hang-ups, and it's you know, we try to be as logical as possible, but it is difficult.
Should we move on to British American Tobacco?
Yes. So British American Tobacco, we've covered it a number of times before in the show. It's the UK's largest tobacco company and one of the biggest companies on the FTSE 100. They had their full year results out last week with underlying group revenue up by 2.1% to £25.6 billion, in line with guidance. New category growth is up 7%, led by the modern oral products, so that's sort of the snus type products. Combustible revenue grew in all regions except Asia Pacific, Middle East, and Africa. Underlying operating profit grew by 2.3% to £11.3 billion. Free cash flow fell by 48.8% to $4 billion, which is impacted by a $2.6 billion payment in respect of the healthcare related settlement in Canada, and underlying net debt was $31.4 billion. 2026 guidance points towards lower ends medium-term targets, which are between 3 and 5% for revenue and between 4 and 6% for underlying operating profit. The 2025 dividend has been raised by 2% to £2.45 a share, and that's to be paid in 4 instalments. And there have been no changes to the planned £1.3 billion buyback programme for this year, and the shares were down around 1.5% in early trading. In terms of valuation, British American Tobacco has a market cap of £99 billion and trades at 12 times forward earnings compared to the 10-year average of 10.4, and it has a prospective dividend yield of 5.7% compared with a 10-year average of 7%. I think these results were broadly what we've come to expect, with continued single-digit fall in combustibles, high single-digit growth in non-combustibles, and revenue up in the low single digits. And that, I think, Sam, would be a fair to say that how it's been in the last 5 years, really. You are seeing you have seen a significant re-rating in the shares over the past, probably last 2 years, really. Very similar to Imperial Brands, which is number 2 on the UK market. And the shares of British American have been up 91% in the last 2 years and 50% in the last year. I suspect with the uncertainty with AI, the market has rebalanced, and you are seeing, or you have seen, demonstrated consistent, reliable cash generation from both of these businesses, which is not likely to be the victim of AI, and perhaps the market now placing more value on that. I don't think the shares are expensive at 12 times forward earnings. I think if you look at it compared with a few years ago when we were seeing sort of, Ps of 7, 6, 7 with these companies, it's much more expensive than that. Other comparisons, I guess you could compare it with its US peers. And again, it doesn't look expensive from that perspective. But I don't think you're seeing that sort of potential of what people saw like Kenneth Dart a few years ago with a huge value play here. They have normalized significantly, so perhaps less attractive to the value investor now. Sam, what are your thoughts on British American?
I wouldn't be comfortable buying it at 12 times earnings. I know we've gotten used to seeing it a lot cheaper. That doesn't mean we'll get that again. But if you kind of look at it over 10 years, I think in times of a bit more kind of political uncertainty, it does, it is a defensive stock. It does tend to rally. And a lot of the time it does seem to sort of trend back down after. I just think the yield, 5.7%, obviously that's not a terrible yield by any means, but you can get that from a lot of REITs. I'd be more comfortable owning the REITs. They have, they are still having the volume declines, which we expect, but that new category growth of 7%, it's not amazing. It's nice that it's growing again, but I just think for 12 times earnings, you can get a lot of stocks that aren't in terminal decline for that. It's a stock at the right price. I'd be quite happy to go and buy back again. I also don't love that they're still doing buybacks when the valuation's basically nearly doubled. I would rather see that distribute to shareholders in the form of more dividends. I think the debt is starting to look a bit high. It looks worse than it is because that free cash flow has fallen 48%, so it's distorting it a little bit. But even still, I just think for 12 times earnings, I think you can now do a lot better. If it dropped down to kind of 6 or 7 again, I'd be very, very interested in it. But at 12 times earnings, I don't think, the main argument for buying a business in terminal decline is always going to be valuation, and I just don't think that valuation's there at the minute.
Okay, fair enough. So not one for you, Sam.
Not for me. But in fairness, if it was cut in half, I would be very interested again.
Okay.
But I can say that for a lot of businesses.
Okay. Fine. On to Magnum.
So this is technically a debut on the show. Well, it is a debut on the show. The Magnum Ice Cream Company. So they were recently spun out. They were the ice cream division of Unilever. Absolutely dominant in ice cream. They've got Walls, they've got Magnum, Cornetto, Ben & Jerry's, Carte d'Or. You could just go on and on, really. They've got the ice cream market pretty locked up, really. So they actually have a 21% share of the global ice cream market, and that's nearly double the nearest competitor. That global ice cream market is forecast to grow by 3 to 4% annually until 2029, and Magnum Ice Cream Company thinks they'll grow a little bit higher than that. They think they'll grow at 5% annually. So this is their first set of results since being spun out from Unilever, and they've reported full year revenue of 7.9 billion, and that reflects underlying sales growth of 4.2%. This is slightly below what was expected, and they've said that's due to slightly lower volume growth. Underlying cash profit fell 6% to 1.3 billion, and all these figures are in euros, and this was below market expectations due to unfavourable currency moves and higher than expected service agreement costs with Unilever. Free cash flow fell 95% to 38 million due to separation costs. Net debt rose from 300 million to 3 billion due to payments to Unilever to complete the separation. So as we've seen before, when companies like this are spun out, we saw it with Haleon a few years ago, the parent company tends to take the opportunity to get rid of maybe an unfair proportion of the debt that exists within the overall structure. But anyway, they've got the debt now. So in 2026, organic sales growth is expected to land in the 3 to 5% range. Underlying cash profit margins are expected to improve by 0.4 to 0.6 percentage points. The shares fell 14% following the announcement of these results. I think the results aren't terrible in terms of the growth. I think the debt is unfortunate. There's nothing they can do about that. In terms of the valuation, they're trading at a forward P of 15.6 and an average forward since listing of 13.5, but they've been listed less than a year, so how useful that average is debatable. I think these results are okay. I think there's not a dividend at the moment, as you'd expect. Again, this tends to happen after a couple of years. I don't know how I feel about this, because I think the main thing that would be, I wouldn't say putting me off, because I wouldn't be interested in any way, but I think the main negative for it is the debt, and that's not their fault. However, the debt is there. That being said, underlying cash profit is 1.3 billion. 3 billion of debt is pretty serviceable. But then the growth's not amazing, but it does have some really, really high quality brands. I think for me, I'd probably need to sort of follow it for a couple of years and see what happens. I think having seen what we've seen with Haleon, if after 2 or 3 years they start chipping away at that debt, I think all of a sudden it can start to look a lot more attractive. So I'd probably wait and see. I think if I'd held Unilever shares and I'd ended up with this, I think I'd probably give it a bit of time. Interestingly, the share price had done very well since it was spun out. So it was spun out at about £11 a share. It's now over 12, and prior to these results, it was actually at 14. And I think it was up about 40% since it had actually been spun out, or something like that. So yeah, I think these results aren't anything to write home about, but I think probably just need to wait and see with this company. John, as someone who does hold shares in it, what do you think?
Well, that's a good question. I think largely what you've said, in the sense that because it was only a relatively small part of the overall Unilever, and it's a tiny, tiny part of my portfolio, I'm happy just to watch from the sidelines and see how it goes. Yes, I take what you're saying about the debt, and there's just nothing. It's typical, and that's kind of what you'd expect Unilever to have done. It is serviceable. I suppose one longer term fear with Magnum, and certainly if you were looking to buy shares and take it a longer term view, is yes, it does have some very strong brands in there in the ice cream market, but you do wonder what the future of the ice cream market is going to be like, because this isn't like a balanced portfolio of having lots of different food types. Ice cream is generally unhealthy, and yes, it's a sort of treat and people can enjoy it, but you do wonder with GLP-1s and moving from the injections to GLP-1 tablets, what the longer term ice cream market is going to be like. It does have its expenses anyway, in terms of you have to freeze the product, transport it, and everything else. But in the sense that it's just purely kind of what you might consider junk food in a new world in 5-10 years time, if everybody is, or not everybody, but a large number of the higher volume users are having GLP-1s, they no longer feel like indulging or treating themselves to a Magnum or a Ben & Jerry's. What does that do to the business model? I think that would be a longer term concern with it. For me, having a small number of Magnum shares that have just come as part of the sort of spin out from Unilever, it doesn't really make too much difference either way because it's such a small number. But I would wonder about that longer term investment case. I mean, what would your thoughts be on that, Sam?
It should be kind of a treat. But I think the problem is if you strip out a lot of the heaviest users.
Customers.
But if they will make up a lot of the sales, and if they are the people that will be on the weight loss jabs. But I guess it's a nice hedge if Novo Nordisk continues to do badly.
Yeah.
And then maybe it'll just be Eli Lilly taking up more market share, and they'll both do poorly. But it's got the same problem as Diageo, though.
Yeah, I do take your point with Diageo.
You could argue that a lot of those brands are kind of higher quality. So it's like if you want to treat yourself on a summer's day, you might go get a Magnum kind of thing. It's not the same as like the sort of sludge you get in the big tubs from supermarkets.
Yeah.
But I take your point. I wouldn't be hugely optimistic because I think even without the GLP-1s, there maybe is more of a push towards kind of healthier sort of unprocessed foods.
And it's interesting when you do, I mean, we'll come on to Unilever, but when you look at like, your Unilevers, your Nestle's, they are making more healthy sort of pivots. And it's difficult to see that happening with the ice cream business. I know you could probably have
frozen yogurt.
Yeah.
But I don't think that's as big here.
No. And I think it's, and it's like, can that drive the growth? I think there are, I would have social concerns.
What was like the USP of, we went to that coffee thing and there was that guy who had the ice cream.
Oh, yeah. Okay. Yeah.
Was his in some way using better or healthier ingredients, or was it just that it was local that was of USP?
I think it was that it was local. It was high quality. It was very much treat. And he was also looking at, because, there's obviously a huge seasonal component to it, but going more into milkshakes as well in the off season and expand. And he was doing coffee as well. So it's not just an ice cream parlor, but it's more like a coffee shop too. So he was expanding it in other ways like that.
He had a shop though.
Exactly.
Yeah, so they can't do that, can they? Really?
Yeah. So anyway, just having the conversation now does make me reflect on the Magnum shares and think, well, actually, we've done all right with them. Maybe it's time to call time on them, but yeah, we'll see.
Should we move on to a company that now has 3 billion less debt than they did the last time we covered them?
Yeah, that's right. So maybe it's a time to sell the Magnum and buy some more Unilever. But yes, Unilever, I mean, we've covered it lots of times on the show before. It had its full year results out. And for anyone who doesn't know, although you probably will know by now if you've listened to the show for the last couple of years, but it's got brands like Dove, Shaw, Lynx, Domestos, Persil, Hellmann's. I mean, it's a huge portfolio. And the chances are, even if you've never heard of Unilever, you probably use their products. Anyway, reported full year revenue came in at 50.5 billion euros, reflecting underlying sales growth of 3.5%. Performance was driven by its power brands, which grew faster at 4.3%, and all business units and regions were in growth territory, which was very positive. Underlying operating profits dipped 1.1% lower to 10.1 billion euros. Sales growth and cost savings were offset by unfavorable currency moves. Free cash flow fell by around 400 million euros to 5.9 billion euros, and net debt was 23.1 billion euros at the year end, down from 24.5 billion euros in the prior year. In 2026, underlying sales growth is expected to land at the lower end of the 4 to 6% target. On the 6th of December, it completed a demerger of its ice cream business into the Magnum Ice Cream Company, which it still holds a 19.9% stake. And the shares were down around 1.5% in early trading. In terms of valuation, the group has a market cap of £117 billion and trades at 18.9 times forward earnings, compared with a 10-year average of 17.9, and it has a prospective dividend yield of 3.3%. I thought these results were a bit disappointing. We know that Fernando Fernandez is the new boss and only about a year into the job, so I think we do need to give him some time. But that being said, we had a new boss before that who was only in post for, I think, about a year. It wasn't very long at all. Some positives, I think the focus on the 30 power brands and the margins are ticking up. But I think you would hope to see some more revenue growth, particularly in the emerging markets, which has always been a key part of the investment case for Unilever, with the growth in the middle classes in countries like India. And that has been fairly tempered. The shares have re-rated, and I remember it wasn't so long ago that we were talking about a PE of 15. But equally, I think we've been waiting for a growth strategy for the best part of the last 10 years. And it does have a top-tier brand or stable of brands, but it just really feels frustrating that it hasn't properly been unlocked. And I think what you've seen with the re-rating of the shares is probably more that almost that shift away from AI. And the Unilever shares are up 15% in the last few weeks. But I think that's more sort of rotation within the market rather than anything fundamentally changing with Unilever. So I continue to hold the shares, but it's frustrating. I think when we went to Fundsmith, which is actually next week, but last year, Terry Smith, who does have meetings with Unilever and is a big shareholder, had met with Fernando Fernandez, who was the former CFO and now obviously chief executive. He rated him very, very highly. So perhaps we should be giving benefit of the doubt and seeing what he is able to do. But it's still sort of underwhelming for me. Sam, what are your thoughts?
Similar. It's his first year in the job, but yeah, if we're sat here next year and it's like that, it's like, well, what else do you do?
Yeah.
They've spun out the ice cream. They got out of tea. They've had numerous CEOs have a crack at it, and no one seems to be actually able to unlock the value that's there. I think the growth's disappointing. Net debt's down, but we know why that is. And even then, 23 billion down from 24.5. So it would have gone up were it not for shafting Magnum. Yield's quite low at 3.3%. That's historically been a bit higher. It's usually hovered around 4. Forward PE of nearly 19. I just don't think it looks that attractive at the minute. I think the only sort of saving grace is sort of how highly the CEO is rated, and he's only a year in the job, but it seems to be re-rated as if he's already fixed it, and that's not what is reflected in the results. So yeah, I certainly wouldn't be buying at this price.
Yeah, disappointing again. Well, we'll see what Terry thinks, because I guess with this and with Novo Nordisk, they're two things that will have underperformed in his portfolio. So I'm sure he will be asked about that next week.
Yeah. So should we move on to Shopify, a business we've not covered for a few years?
Yes. How have they been doing in the interim?
Well, based on the share price, a lot better. So Shopify, they are the e-commerce platform that basically sort of sits in the background for a lot of small businesses. They have reported their Q4 results, and they reported a 31% rise in revenue to $3.7 billion. And all these figures are in dollars. And growth was driven by a 31% increase in the value of orders processed through the platform to $124 billion. Operating profit rose 36% to $631 million, driven by top-line growth. I should actually say, I've just realised that this company is actually Canadian, not American, but they are listed in the US. So
North American.
Yeah, our North American company of the week. So yeah, operating profit rose 36% to $631 million, driven by top-line growth. Free cash flow rose 17% to $715 million, and there was a net cash balance of $5.8 billion at quarter end. A new $2 billion buyback was announced. First quarter guidance, they're expecting revenue growth in the low 30s, not bad, and the shares were up 11% in pre-market trading following the announcement, but actually finished down 6% on the day. But I think that's because of AI fears. Last year, they did announce partnerships with ChatGPT and Gemini, where basically Shopify would be kind of integrated into that. In terms of the valuation, they trade at a forward price to sales ratio of 11.4, and that compares to an average of 15.7. If you were to look on price to earnings, it's at 68 times. They don't pay a dividend, but they are buying back shares. In terms of the share price performance, since we last covered it, the market cap's 164 billion. I can't remember exactly when we last covered it, but if we just look at the share price, so it peaked, it was a COVID sort of stay-at-home stock kind of thing, but it peaked at around $176 a share in late 2021. And then the growth started falling and it bottomed out at around $26 a share, so down from a 176 to 26, high to low. I don't think we quite covered at that price. I think we covered it around $50, $60 a share from memory. But since then, it's sort of rocketed back up to 175, I think, or 172, or about 170. And then it was basically near the all-time highs, except for this AI pullback. So it's now at $127 a share. Yeah, I just think it's an interesting business. It's a business I like, and it's a business I would be attracted to at the right price, but I don't feel like I'm ever going to see that price now. I think even last time we covered it, for me, it was still too expensive. I appreciate the growth was a lot worse then, and I don't think it was clear whether it would pick up or not at that point. But yeah, 68 times earnings. If it carries on growing 30% a year for years to come, you could do very, very well of it, but it is priced to perfection. And for me, I'm not interested in paying that for a business where I can't really get a gauge of how saturated it is. What do you think, John?
Similar. I mean, I think it's a fantastic set of results, but I would have some AI fears, and also, the saturation, you just don't know. So I think there are too many unknowns. It is priced to perfection, and I certainly wouldn't want to or be brave enough to buy shares.
So of the 6 businesses then this week, Barratt Redrow, Coca-Cola HBC, British American Tobacco, Magnum, Unilever, and Shopify. I think you now own half of them. So which do you like the most and which do you like the least?
Tricky. I think I would probably go for Barratt Redrow on valuation, but I think quality-wise and with the current momentum, it would be close whether I would just pay up for Coca-Cola HBC. Probably what I should do. But yeah, that would probably be in terms of the top picks. And then again, on the valuation basis, I go for Shopify as the last choice. Very expensive.
So I think for me, I think I'd probably do Coca-Cola HBC first. It's expensive, and I don't really want to pay 21 times earnings for it. But I think out of those businesses, I think I'd probably rather pay up for Coca-Cola HBC than save a bit of money and get Unilever, because you can see the difference in the performance, and the price is not that different. Least favourite, I think it would have to be Shopify on valuation. If it was actually based on the business instead, it would probably be Magnum, but like we've said, the bet's not their fault, but then we couldn't exactly make a convincing argument for the future of the ice cream market either.
Yeah, I sort of overlooked Magnum a bit, but I would have some serious concerns there.
Something to reflect on.
Yeah, it is very much.
Right, I think that's everything in that case.
So if you're coming to Fundsmith, we will see you on Tuesday.
If not, see you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.